let's talk about a choice that could literally make a difference of lakhs of rupees for your future. It's the classic financial showdown, right? Fixed deposits versus mutual funds. And if your goals are anywhere from 5 to 10 years down the road, this is a decision you absolutely have to get right.
You know, we're all taught to put our money where it feels the safest. But let's just stop for a second and ask a really important question. The one you see right here. Is that safe money of yours actually growing? Or is it just sitting there while the world gets more and more expensive all around it?
And this right here, this visual just sums up the whole problem. Think of it like a seesaw. On one side, you've got the small, predictable interest you get from your savings, but on the other side, you've got inflation, which is always pushing up. So when inflation is rising faster than your savings are growing, your money's actual buying power is going down. You might feel like you're saving, but you're actually losing ground.
So, if the math doesn't really add up, why do so many of us stick with FDs? Well, the answer isn't in the numbers. It's all in our heads. It's what I call the FD comfort zone. And in this first section, we're going to dive into why it's so darn hard to leave. Our love for FDs, it's pretty deep-rooted, isn't it? It's the advice we got from our parents, and they got it from their parents. And you know what? For them, it was great advice. They lived in a time when you could get 10, even 12% interest. The logic was rock solid. It's in a bank, it's guaranteed, it's safe. That mindset was perfect for a different financial era. The only problem is, we're still using their old map to navigate a brand new world. And this chart shows you that change perfectly. See that tall bar on the left? That's the past, where those high FD rates easily beat inflation. But now, look at the bars for today. The return from an FD is actually lower than the rate of inflation. This means every single year your money sits in an FD, it buys a little less. The safety you feel is kind of an illusion because the finish line for your financial goals is just quietly moving further and further away. Okay, so enough theory. Let's see what this looks like in the real world. In Section 2, we're going to follow a simple story of two friends, two different paths, and two, well, very different outcomes. It's time for the real growth showdown.
So let me tell you about two friends, Rohan and Sameer. About 10 years ago, they both decided to invest the exact same amount of money, 5 lakh rupees, for the exact same amount of time, a decade. They just chose very different ways to do it.
Rohan, he took that traditional path of safety. He put his 5 lakhs into a fixed deposit. Sameer, on the other hand, did something different. He invested his 5 lakhs into a mutual fund, which really is just a way to pool money to invest in lots of different companies at once, basically tying his money to the growth of the whole economy. A decade goes by, and the results are in. Rohan's FD, it grew to just under 9 lakh rupees. Sameer's mutual fund, however, grew to an incredible 15.5 lakh rupees. That is a difference of 6.5 lakh rupees. Just let that sink in. Same money, same time, zero extra effort. But one friend nearly doubled the other's wealth. And here's the key takeaway. Rohan's FD saved his money, while Sameer's mutual fund grew his money. You know, in finance, there is a name for this huge difference. It's called opportunity cost. It's the invisible price you pay for playing it too safe. It's all the potential growth you just leave on the table. For Rohan, the real cost of his safe decision wasn't a bank fee. It was the 6.5 lakh rupees he never even had a chance to earn. Now, I know the big question that's probably buzzing in your mind right now. It's the number one thing that holds people back, and it's what we're going to tackle head-on in Section 3. What about the risk? This is the one, isn't it? But what if the market crashes? The idea of seeing your investment value go down is absolutely scary. It's a completely valid concern, and honestly, it's what keeps so many of us stuck in that FD comfort zone. But here's the thing. The most powerful tool we have against market risk is something we all have: time. Just look at how risk changes. In any one year, sure, the market can be a total roller coaster. But if you stretch that out to 5 years, the ups and downs really start to smooth out. And over a 10-year period, well, history shows that markets have a really strong tendency to grow, which makes the chance of a permanent loss incredibly low. Time gives your investment the breathing room it needs to recover from those dips and really capture that long-term growth. So, this brings us to a whole new way of thinking about risk. Mutual funds have a visible risk, right? You see the daily ups and downs. But fixed deposits have a hidden risk, that silent, invisible thief called inflation, just eating away at your money's buying power. So the real question you have to ask is, which risk is more dangerous to your long-term future? The one you can see and manage, or the one you can't see until it's too late?
Which brings us to our final section. This is where all the numbers and charts connect back to what truly matters. Your goals, your life. This is section 4, your future, your choice. Let's really bring this home. Why are you saving this money in the first place? Is it for your child's education? A goal that gets more expensive with every passing year? Is it for a down payment on that dream home? Or maybe a retirement where you can finally relax and not worry? These big, important life goals, they all have one thing in common. They require your money not just to be safe, but to actually grow. So if you remember just one thing from all this, let it be this simple summary right here. A fixed deposit is designed to save your money, to keep it stable. A mutual fund is designed to grow your money, to build your wealth for the future. They're just different tools for completely different jobs. So we'll leave you with this one question to really think about. Take a good look at your own investments and ask yourself, is my money just staying safe, or is it out there, actively working to build the future I really want? The answer to that question, well, it's going to tell you everything you need to know. Thanks for joining us.